Hi guys, in this video I'm going to talk you through how it is possible to retire early from the NHS even as a Band 2 worker with over £1 million in investments. I think it's taken me a while to produce this video because whilst it is possible, it's not easy, and it did seem a bit like a sort of a clickbaity suggestion. However, it is real. Just to talk you through, so at Band 2, if you look up the salary calculator, you will see that your net income is just over 17,000 a year currently, and monthly that translates to just over 1,400. And what I have done in this sheet is I have allowed £400 a month for living expenses. So what I'm talking about there is basically shopping, clothing, or that kind of thing. Once you subtract that, that leaves you just over 1,000. And I've also allowed 500 for housing. Now that is really very, very little. However, if you are a single person, particularly if you're living at home with your parents and you have no responsibilities in terms of children, etc., and I appreciate that's probably not the case for the majority of NHS workers, but if that is your situation, this should be doable. So you can see that after living and housing expenses, you should be left with just over £500 per month, and that is the amount that I have indicated that we're going to invest in this example. Now that gives us an investment rate, or ratio I suppose. Basically the proportion of your income invested in relation to your net income here is just under 37%, so it's quite a large chunk. However, I'll demonstrate in another video why the investment rate is probably more important than your actual income in terms of the ability to achieve FIRE. Now, just moving across then, I have listed, it's quite obvious here, just the age. So if we were to start this at age 21 and run it until age 55 in this example, so is that about 25 years? It may be, let me just check and see how long that actually is. So it's just under 35 years actually. Okay, so if you were to work in the NHS at Band 2 for 35 years and you were to begin investing as soon as you began, at the end of the first year, your monthly investment should be worth 6,300 odd, and I have calculated the expected gain of the S&P 500 to be around about 10% per annum, and if you follow J.L. Collins, you'll be aware that that's actually less than the figure that features in his book, The Simple Path to Wealth, which I highly recommend. I've adjusted downwards simply to, I suppose, to add in a bit of a, what would you call that? Basically not to be over optimistic. Okay, But as with everything in investing and finance, we do need to point out that this is not guaranteed. This is purely an example of what could be achieved, providing that the market continues to provide the kind of returns that we have seen in the past. But as we know, stock markets can fall as well as rise, and there are no guarantees. And it is important, if you're investing, to invest in a diversified portfolio to protect your assets. So, with that caveat aside, at the end of the first year of investing, you may well expect to see a rise, provided the market performs as expected, of in around £630. Then what we do is we add that gain into the value of the second year's investments. So basically the first year and the second year, over that space of time you can expect the value of the investment to double. So without the gain, you would expect that figure to be in around 12,600. So as you can see, with the extra, then that brings it up a bit more. Similarly, because interest is compounded, so in other words, in the second year, you are hoping to get a 10% rise in the stock market, but because the value of your investment is now the value of the investments that you've put in year 1 and year 2 plus the growth from year 1, then you're now getting 10% of all of that. So we're looking at about 1,300 of a rise in the second year, and so on, basically. If you look at the formula, you'll see how this is worked out. So at the end of the first year, it was quite simply the amount invested times 12. The gain is quite simply the total of that times 0.1 or 10%. And then in year 2 we have F8. So that is the annual net investment plus the same again, plus then the growth from the year previous gives us that. No, I need to come out of that because I've done a boo-boo there. Right, how do I get out of that without... Okay, right, so that was that. And then, as I say, that's just simply repeated down each year. And let's have a look at a couple of key points along the way, I suppose. Once you reach year 10, you can see we're into the 6 figures just. By year 15, so let's actually just... that figure just caught my eye. So year 10, you're already at 100,000. It's not going to take you another 10 years to get to 200,000. You achieve that by year 15 just with the compound interest. So that just shows you the power of it. That the second marker, if you like, is done just in half as much time. From year 15 to year 20, we're now up to 360,000-ish. So, and then from year 20 to year 25, you're looking at roughly 620,000. So over 500,000 by that stage. And as you can see, I've thrown in here mortgage-free question mark. So obviously that's based on the fact that a lot of mortgages are taken over a 25-year term, and If you did happen to be mortgage free at that point, then it goes without saying that the amount of money that you were previously spending on housing is no longer required for that. You could afford to invest that extra from there on. Now, I haven't factored that into this calculation. We don't actually need to, as you can see. Year 25 to year 30. Actually, at the year 30 point, we're already just hitting the £1 million. And then if you were to work a further 5 years, you would be able to retire, hypothetically speaking, at 55 with just around 1.7 million in your investment portfolio. And if you look into the safe withdrawal rate, generally accepted to be 4%. Now that is based on people who are retiring with an expected retirement of around about 30 years. So if you're going much before that, you may need to adjust that down the ways towards maybe 3.5%. But just to let you see what that would potentially give you as a safe withdrawal rate per annum, you're looking at the pot value times 0.04. So annually you should be able to withdraw roughly 68,000, and the pot should be safe in a lot of models that should be able to be made up by the increase in value over the next period of time. And the safe withdrawal rate is generally safe, even when market falls happen. Yes, if you were to work 35 years at band 2, hypothetically speaking, after that time you would be able to afford yourself quite a nice retirement and a significant pay rise. Should you choose to do it that way. Now, I do want to draw your attention to some limitations and so on that I have noted here, particularly because it is important to be aware of them, and just to say that there are other things I'm sure that I have not noted which are probably equally as important. So number one, inflation is not factored into this calculation. Things will likely cost more in future, although that said, as I say, I have used an expected growth figure of 10% as opposed to around about 12%. Spoiler alert if you're going to read J.L. Collins. Changes to tax and national insurance rates cannot be predicted. I suppose basically saying that your net income could be influenced by changes to those contributions. When interest rates are low, mortgage debt is good debt. You will hear this said elsewhere, and I suppose generally what it's saying is, whilst a mortgage technically is a type of debt which must be repaid, if you have a mortgage interest rate of say below 4 or 5%, if you're expecting a 10% growth or more in the stock market, it's not particularly in your best interest to pay off that mortgage early or very early, as you can make substantially more by investing the money that you have in the stock market instead, and maybe choose to pay off your mortgage once you're ready to declare financial independence, should you choose to do so at that time. So should mortgage interest rates rise significantly, you may be better to overpay your mortgage first. Okay, so that's basically saying the same thing. Key points. The percentage investment rate is of greater importance than your income. Absolutely, and you will see that in another video which I'm going to make on that specific topic. I'm not going to make this one any longer than it needs to be. The longer you're invested in the market, the more your money can grow. Now that's essentially paraphrasing a J.L. Collins catchphrase, which would be that time in the market is more important than timing the market, and really you cannot time the market. You never know what it's going to do, but time is key. The longer you have your money invested, the more it can grow. And if you listen to the Money Guy show on YouTube or podcast, you will hear them talk about your army of dollars, which are fighting to make money for you. So it's generally on the same concept. So I've said this already. The generally accepted safe withdrawal rate of 4% per annum may need to be decreased, say, to 3.5% for retirement of 30 years, expected retirement of 30 years or more. Guys, thank you for watching this. I will make the file available online so as you can have a look at it yourself. You can, if you want to, modify these figures that are highlighted in green, just to adapt it to your own situation, and I encourage you to have a play with it and see how it looks for you. If you enjoyed this, I would appreciate it if you wouldn't mind giving it a like, and if you'd like to see more, why not hit the subscribe as well, and you'll be alerted each time I post another video. Cheers.